Fascinating reports. There's a big one on China. There's a big one on Europe. Let's talk about China first, because overnight we got those new China numbers. And the Statistical Bureau that releases them went out of its way to say part of the problem they have on growth is actually what they call a very complex and difficult situation with international matters. I assume that that's trade. Is that the way you read it, Michael?
It is. I mean, some of the export data was quite strong, so I think you can argue that it's not even showing up in trade at the moment. But certainly we think the environment and the relationship between the U.S. and China will become more complex and confrontational over time. We think that the last 40 years was more about cooperation, but the next 40 years will be more about competition. And as China seeks to move up the value chain and have more high technology production, we think that will bring it more and more into conflict with the U.S.
So let's talk first, Michael, about what effect that has in the United States potentially. This is a chart from your report. Now, I want to be clear. This is, I think, 20% tariffs on all Chinese imports. And right now we're talking about going to 25% on roughly half
about
of
half.
them.
That's
but
right.
The president said he wants to go the whole way.
Right.
So you can see what this says basically is if that happened, we would lose about $157 billion in trade because of that as a practical matter. How much effect would that have on the Chinese economy?
So China is not as large as the U.S., and it's a little more trade intensive than the U.S. The rule of thumb is it hurts them about twice as much as it hurts us. So the numbers that we show there would be a change in trade volumes over a 3 to 5 year horizon, and we think it would be like up to about 0.5% on growth in China, maybe 0.25% on the U.S. just through the trade channel alone.
Shawn, are we going to get there? Because there was a report out of the South China Morning Post today that, in fact, President Trump will meet with President Xi, according to one source at least, at the end of next month down in Rio de Janeiro.
I don't think we're going to get there in the short term. I mean, this is going to be a long process. You know, at Barclays Research, we've been publishing reports. We've hosted events in the last week in both in New York and London on this issue. It's two sides. One is the bilateral trade deficit. How is China following the WTO rules? The other is all the new technology, artificial intelligence, which really comes down to a military situation where the U.S. is very worried about Chinese dominance in the military in terms of how they're leading on artificial intelligence.
At the same time, there has been speculation, I don't know if it's informed or not, that in fact once President Trump gets past the midterms, he'll have more maneuver room. And in fact, he could do something with the Chinese, who certainly are eager to talk. They keep saying they want to talk. So do you have any hope at all that maybe something could come about from this meeting if it happens?
I am hopeful. I think this is going to be a large bilateral meeting that's going to take quite a bit of time. For instance, with NAFTA, you have a large process in place. You have a deal. You can work through it chapter by chapter. With China, we're still writing some of those early chapters. So this will be a long process, regardless of what happens in the midterm election.
One of the things that is illustrated in your report, frankly, with respect to both China and Europe, is when these things happen, consumers bear the brunt of it, Michael.
Right.
That they really pay the price. The government gets some money in tariffs, as President Trump keeps telling us about.
Right.
But the fact is, we don't get as much money for the government in tariffs as the consumers have to spend.
That's right, and there's a timing issue here, right? So you're exactly right. Initially, tariffs go into place. The government collects revenue. To the extent that it's passed through to consumer prices, it acts like a tax on consumption. Over time, if the goal is to reorient production and bring some of it back to the U.S., then maybe you have more profitability in the corporate sector. But there's a time element here where you could very well have a larger negative economic effect in the short run with uncertain positive gains in the long run. So yes, we have to try and net all of these out. So when we say the U.S. may lose 0.5%, the consumer may be losing several times that amount. So if you combine that with a risk-off move or a drop in confidence, there are channels through which this could be very problematic for the U.S.
Now, Shawn, as I said, we also have issues with Europe, with the president at least threatening possible tariffs on autos from Europe, which really gets their attention. And we had meetings with Cecilia Malmström, this is Wilbur Ross, the Secretary of Commerce, on Wednesday, that didn't seem to have gone very well. And I'll quote in part what he said about, in respect to Cecilia Malmström, our purpose in the meeting was to address the need for speed and for getting to near-term deliverables, including both tariff relief and standards. At the same time, he said they didn't make the progress they wanted, and actually they didn't have that much patience left.
Absolutely. We're seeing this building quite a bit. And the president's been putting a lot of pressure on Europe. Through our research side, we figured out that a lot of this is going to settle on European autos. And we're waiting for this critical report right now from the Department of Commerce about whether they want to label European autos and auto parts as a national security issue.
Now, one of the issues actually is how much of a trade situation do we have with Europe? And Michael, again, referring back to your report, you illustrate the fact that actually, compared to other places like China, the NATO countries taken as a whole are not that big a trade partner.
That's right. And actually, we find that the trade deficit just started to widen after the end of the Cold War. So when we and Europe recognized the peace dividend, so European military spending generally fell, and there's a heavy trade component between Europe military spending and U.S. exports. So Shawn and I conjecture that if Europe and NATO are serious about moving to their Wales Summit declaration and increasing military expenditures, some of the trade deficit problem could go away. And then, therefore, you are left with autos, and that's why we think the focus is on autos.
It's interesting. I had not focused on the fact, Shawn, that maybe the NATO pressure that President Trump is bringing to bear actually may help him on his trade deficit. But with respect to that trade deficit, it's overwhelmingly apparently from automobiles from Germany, basically. That's where it resides.
Absolutely. But I think what Mike mentioned is really interesting. I mean, for the U.S. administration, if they want to tackle and try to kill two birds with one stone, get NATO countries up to that 2% and lower the bilateral trade deficit, they could push more U.S. defense exports to Europe.
Right. What's key is you have a 2% of GDP defense target in NATO, but then you also have a secondary target that says 30% of your expenditures have to be on equipment. And that's where you're getting the U.S. export content. So that's the link.
The President of the United States has said to Wilbur Ross, I'd like you to do up a report to figure out whether, in fact, auto imports affect U.S. national security. We don't have that report yet. Explain to me how he's going to draft that report, because Wilbur Ross seems to indicate he's headed in that direction. What is that report going to say? Steel and aluminum, I can kind of understand. I don't get autos.
I mean, this is going to be a very tricky political situation for them and is going to cause, obviously, a strain in that relationship. But they're going to try to look for different ways to mold that to fit that narrative if they want to go down that path. And I think it's important to be careful just to assume they're going to do it based upon one good meeting or one bad meeting. We're still not there yet, and we have to wait and see.
So Michael, finally, let's put ourselves in President Trump's position right now. He's talked about growth, and what your report indicates is if we go down this path, it's not going to be good for U.S. growth.
Right.
But he's talked much more about jobs. He said he's first and foremost a jobs president. Do we make up in jobs what we lose in the economy? Even if we don't have GDP growth, are we going to have more jobs? Will he deliver on that part of his promise?
I mean, not necessarily, but the answer to this is less clear. The effect on growth is fairly straightforward and clear. Your point is exactly well made. It's not going to help growth. The effect on employment's a little more ambiguous. You will likely get more employment in these protected industries. So if you are able to bring some of the production process back to the U.S., yes, you'll see more employment in manufacturing and perhaps some of the higher technology manufacturing. The question is, will you lose it elsewhere? I think unlikely you might. So I would say it's doubtful that you're going to get a much better employment picture out of a high tariff environment.